And that means we are live here on our YouTube channel, Tackle Trading's Halftime Report. We've got the same crew here today, Tim, Mark, and Noah. And we got the young man, Tanya, in the back end doing some hosting while Cody is gone. Mark, how you doing today?
Not too shabby, hanging in there, trying to keep those positive mental spirits that I think are very important more now than ever.
You know, it was funny yesterday, Mark, when we ended the show, I called it and then I didn't take the live stream off YouTube. We literally, we could have been walking into a pickle there. Sometimes we have some indiscriminate conversations after this show.
Listen, my swearing when I'm not live is about 10 times, 20 times higher than when I'm live. So yeah, I'm glad that we're talking about other things.
Noah, all things considered, it was kind of a funny gaffe, but it could have gone badly, right?
Oh yeah, like I once left a live class and then I sat there and scratched my nose and stuff. It could have been pretty embarrassing if I'd let that go.
You know what's pretty funny is actually I've started to see this online because Zoom, one of the companies that has become very, very popular in all of this new economy that we're in, at least during March and April right now. So many companies have moved to Zoom and so many people have never used video like meetings before from home. And I've seen videos where like dudes will get up from the desk and they're not wearing pants. I see videos where somebody's walking through the background and they just got out of the shower or something and like some big corporate meeting. There's been some gaps, and I bet there's going to continue to be some gaps as people learn, how to actually work from home, right?
Absolutely. There's some interesting technology out there. I'm just trying to avoid some of those, forget to turn off the microphone while you go to the bathroom type experiences. Like those are the most embarrassing I've seen.
Sure. And we've even had the naked baby on this show.
We have. Now that was a legit naked baby, and that could technically still happen at any time.
All right, let's get down to business here. Obviously, markets are down now. Let's bring the chart up on the S&P 500. Let's talk a little bit about what we're seeing in the market. It's amazing the new world we live in, Mark. Markets are down almost 4%, and it just feels like another day so far. Now, it could turn and spin into something completely more, but technically, we're in an intraday range here, which is really, really interesting. Before I get into the headlines, Noah, just break that chart down for me and make sure you go down to the intraday when you can.
Oh, you bet. So first of all, again, we all know the general context at this point in time. Big rip down and a couple days rally up, stalling out about 2650 ballpark, not quite, but right in that neighborhood. It hit a double, triple top up there, came up and hit, dropped back down, came up and hit, so dropping back down. So when I switch down to the intraday time frame, and depending on if we look like in an hourly chart, you'll see a big old M for murder type, pattern forming. So when we drop that down let me get down into that hourly chart, you'll see the big old double top, and there it is, came up, kissed that resistance zone, established that, dropped down, came back up and hit it a few times trying to break through, and then it's come back down. You can see an M-shaped pattern right there, where if this support zone breaks and that little 200 hour moving average, if that breaks, then you've got some room for that to drop, I think, pretty quickly down to the 2300 zone without a lot of other technical support in the way. So, overall context, I think is really what we're expecting is more bearishness and, did a little bit of downward momentum. The volume's still waning on this. So we'll watch to see if we see an uptick in the volume in the selling pressure.
Yeah. Yeah, I mean, first of all, we've been talking about this rally the last week or so, Mark, and the different investing theses that are out there. The buy now, everything's going to go straight back up. I think we pretty much scoffed at, quite frankly. In fact, I think we used the phrase bull trap here a couple times. Now, it's not been officially confirmed as a bull trap till you break below that intraday range. But what's your read on the action here today, Mark?
Well, I've used more colorful language to describe investors with that mentality. I really think what happened over the last few days, it was, you have a group of individuals who for 11 years, right, buy the dip, market will rally, buy the dip, market will rally, this unwavering faith that it will go up. They were suffering FOMO at the highest level they had in a long time, right? Mm-hmm. The highest level in a long time. And for pro members and the different meetings and here on the halftime report with our extended community, it's tried to point out is like, that's one way to approach it, right? But we've outlined that thesis with great detail in written work, in different videos. It just seemed a little naive, to say the least. And this is coming from someone who fits in the bull camp. I am not eventually, yes, like as far as a long-term bull thesis. That doesn't mean that there aren't, I mean, it just seemed naive to think that in the midst of everything we know, everything we outline, that like these kind of days aren't around the corner any given day, right? And so there's different ways to approach the market. We talked about this on the podcast. I talked about this weekend. Like there's different ways to approach the market. You need to find a way to approach this market that you will be happy with your decisions. And I'm not talking from a trading point of view. A trading point of view, we can go bullish, we can go bearish, depending. Well, I'm sure we'll talk about, throughout this show about the bearish retracement and the different signals that have been popped up all over the market over the last few days. Nice quality bearish setups. There might be good trading opportunities to the bull side 3 weeks from now, right? Especially from a day trading point of view. So trading and investing are two totally different mindsets. But for the investors, while I fit into the bull camp, like, patience, young one. Like this will play out. This will provide opportunities. But like, you don't get greedy and think, well, what if the S&P? What if Apple rallies to 300? That is a hope trading plan. That is a greedy trading plan. That is a naive trading plan.
100% agree. 100% agree. And by the way, these short-term bullish buy now, there's no problem. Things are going to just V-shaped recovery. They're about as likely to convince me to believe in their argument as Carol Baskins is to convince me that she didn't kill her husband, Noah.
Where's your husband, Carol?
If you've not seen Tiger King, you may not get that, but I saw that in the chat. And oh God, what a fun distraction right now in a world where we might need it. Mark, it's been foolhardy. We've been talking about it for a week. I mean, obviously, whenever you're down at like 2174 after a huge sell-off in the market, you can get snapback rallies. A very, very short exercise where you just went out and Googled the biggest trading days of all time in terms of points or percentage, you're probably going to find periods like 1932 and 2008, right? I mean, after bear sell-offs, you get big percentage snapbacks. But Noah, that's why we call this a bearish retracement. I mean, there was nothing in the chart or the pivots that confirmed that we were just clearly sailing ahead. If we break below 2,400, guys, isn't it like pretty much a given we're going to be testing that 2,200 level, like probably pretty quickly?
Oh yeah, at least the 2,300 at a minimum. Because you could possibly still see a higher low form, and you could see it rally back out here, assuming there was some really good news. And we saw a little shift in the narrative. But I think in the meantime, it breaks this current level. I think there's not a lot of technical support down there. There's a little bit, but that 2,200 zone will get retested in my estimation.
Yeah. And even from there, then the discussion can happen, Mark, about is it a double bottom? Do we have pivot confirmation? Does data start coming out? I go back and I take notes on this stuff every day. Every day we do the halftime report. The same three themes are basically what we have to still wait for. Number one is the data on the virus actually being contained. And Mark, today and last night, the task force from a president, they came out and President Trump said basically, guys, we're still seeing problems. We're extending this until April 30th. He did that over the weekend, and they were projecting some pretty dire numbers. What do we know on the coronavirus front right now? What is actually in the data there?
I mean, we're going through some nasty times around the world. On a positive front, now Spain has had really intense measures, more intense measures than we have currently here in the United States. You think that it's bad, you think that things are like locked down here across the board. Yes, we have pockets like New York that are, but as far as a country as a whole, we don't. So there's rough, trying to apply what we're doing in the United States to Spain is apples and oranges in my eyes. But Spain is starting to see a leveling off. Like the numbers are still bad, but they're consistently bad. You're not having these spikes. Italy, the same thing. Starting once again, really, I mean, like I believe gas stations are closed, to give you an example of the containment levels in Italy. Once again, numbers are bad, but they're leveling off, showing that something we've known, and we've talked about this for 6, 7, 8 weeks. It's the optimistic side of me, and the thing when mitigation works, social distancing on extreme levels work. We saw this in China, we saw this in South Korea, we're starting to see it in Spain and Italy. On the bad side, the cases in France are exploding. Deaths were the highest that they had been by a significant margin yesterday. Deaths and cases in Great Britain are exploding, highest that there have been, and they are exploding here in the United States. We had almost 900 people die, 24,000 new cases. So trying to, I mean, what we know, not what we guess, not what models predict, what we know is that when mitigation is in large scale enforced, you hit this peak. Now the peak, one thing for people to understand, this peak isn't, oh, we hit and then we drop back down. It's not a, you know, that's not what happens. But you hit this peak, and you might be seeing this in Spain and Italy, where you're hitting this and you're at really, really bad levels, right? I mean, still 800-900 people a day are dying in Spain, 800-900 people are dying in Italy a day, but those numbers have now been consistent for a while. This leveling off is probably a better word to describe it. We're not seeing that in the United States. We're not seeing that in Great Britain. We're not seeing that in France. We're not seeing that in other places in the world. Japan might be going through a whole wave. There might have been some media suppression in Japan. It's a conversation for another day. So what we
let's talk about that now, because I've actually seen recently some very direct posts about how the Japanese market, they've actually handled it very, very well. There's been all these positive things about we should be more like Japan, and that they haven't shut down their economy and all that kind of stuff. But Mark, we may not know the data in Japan, correct?
Yeah, no, I mean, there's reason to believe that the Japanese government has engaged in widespread disinformation campaign. Now, some might speculate that it was because of the Olympics, that because remember, like Japan was we're not canceling the Olympics, we're not canceling the Olympics, we're not canceling the Olympics, until other countries were like, we're not sending anyone, bro. And then now all of a sudden, Japanese governments there's been about face since the Olympics were canceled. It's very suspicious. And that is not me being conspiratorial. That is just facts on the ground. And Japan is now potentially having a potential surge. So you have mitigation efforts on some level leveling off in Spain, Italy. South Korea has been, once again, the stellar. They win the gold medal for how they've handled this from both a technological, a healthcare, and a societal front. But in other areas, what we know, it's not good, which is why you see the government here in the United States outright saying, whether it's Cuomo or Trump or Pence or Fauci, the next few weeks, they're trying to brace the American people that they're not mincing words right now. This is going to be really ugly for 2-3 weeks.
Yeah.
Really, really ugly. And trying to brace for the numbers, because once again, I mean, you jump from 500 to 500 deaths to 400 deaths to like 900 deaths in one day, and when I extrapolate what the government's telling me with really, really stark language, which I appreciate as a citizen, right? Which I appreciate. I want honesty. I want transparency. But they're saying this is going to be really, really bad. Now, the real question now then from a U.S. is like, we know it's bad in New York. How bad is it going to get in Louisiana? It's getting pretty bad. How bad is it going to get in Florida? How bad?
That's funny.
I like that. The Olympics be like, that's cute. And so we got a lot of stuff coming down the pipe here in America. And when this reality of this is bad, we brace for it. I mean, the markets, the cumulative weight of this, I think undoubtedly are playing on market sentiment today.
Yeah.
Are undoubtedly playing on market sentiment, because then you don't know, because everything about when we open up is a guess, right? Like I could say May, I could say June, I could say July. It's a guess, because it all depends on how seriously Americans take it. Are people in certain cities like Salt Lake or in San Antonio or different cities that haven't had a New York experience, that haven't had a New Orleans experience, that aren't having these pockets where it's really, really bad, if they don't take it seriously, eventually something happens there. So there's so many unknowns from the coronavirus front about how it will impact us, how long it will keep the economy shut down. And I think that's weighing on the market tremendously.
You know, there's a growing sentiment out there in the world. I'm seeing this quite often, and I actually agree with it in some ways, but I really think it's dangerous in other ways, where I'm seeing a lot of people saying, guys, just don't bring up the negativity. Don't bring up all this data that we don't want to hear about. I don't want to talk about this anymore, or whatever it is. I'm seeing it on my Facebook feeds, on Twitter. I'm seeing it from certain personalities and all that kind of stuff. And I really do understand it. We have to find moments in our day, Mark, where we find positivity, family, relationships, read a book, get a distraction like watching a show or whatever it is. We can't just dwell on the, oh my God, the world is doomed kind of situation. But when you're talking about your retirement account and your money, you need to actually get real data that actually is impactful and understand it. You can't ignore a freaking problem out there, guys.
Well,
I mean, the markets are breaking down here. What are we going to do? Put our head in the sand and sing kumbaya? I mean,
I was flirting with a woman for the first time. It was our first conversation, social distance on the phone, right? Because nobody meets anyone anymore. You know, dating will re-engage. There's probably a dating. When people start dating, that's probably in full force again. That's probably when the economy is going to turn, right?
Maybe.
You know, but anyways, and she used to work for a big financial company that you would all recognize. And I was like, well, what are you doing with your money? And she's like, I don't watch the news. I'm just going to let it sit. I'm not even going to think about it.
Mm-hmm.
And I was like, well, that's one approach, right? At tackle trading and for individuals, we can't have that ignore reality approach for two reasons. One, there's going to be excellent opportunities along the way. Two, this is our money, our life. Three, there could be some mind-blowing, amazing opportunities to enter into some situations at some point in the future. From a money standpoint, from a callous, cold, but that's what we do, right? That's what we're here for our individuals, hopefully to provide entertainment and solace in this time, hopefully a few laughs, like some Olympic rings, which I still think that's really funny. But like, I mean, these are critical decision points. These are critical decision points. And so in the midst of the chaos, we have to pull up our britches, objectively look at what is going on and make decisions along the way. You can't bury your head in the sand. Now, we still should maintain positive mental health. We talk about that constantly at Tackle Trading. We still should find a way to enjoy life. We should still hug our families close and enjoy and listen to music and enjoy life as much as possible. But we can't ignore what is going on. There's too many things that could impact our retirement, our trading account, and to be blunt, there's too many potential opportunities down the pipeline.
There are life-changing opportunities in front of us. Life-changing opportunities for everybody watching the show and Team Tackle and all those kind of things, for the good and the bad. People who don't take control of what they're supposed to be doing through financial literacy. Noah, how many people in our lives, even in our own direct lives or in Team Tackle out there, they have a friend or a mother or a brother who will seriously never look at their retirement account because they just don't want to deal with the pain. And they'll ignore this thing, no matter what happens. Bring your mic off, young man.
There we go. You know, first of all, there's lots and lots of people that take that approach. You know, if you stick your head in the sand, it's one of our natural defenses, I think. Just kind of like a deer in the headlight, like you freeze, you just don't want, don't move. Maybe you'll survive. It is an interesting psychological phenomenon for sure. And, I've had one of my mentors once tell me over and over again, inaction will rob you blind. Your inability to take a loss will eventually lead to a bigger loss. And so, over time, they'll probably come back. But how many people are delaying their retirement by a decade or so, by doing that? Sure. Pushing that date out, because who knows how long it takes to recover. And of course, it could be a quick snapback, and we're all hopeful of that. But at the same point in time, it's not that hard to move to cash on the sideline. It's not that hard to, and once you learn and you get yourself educated, there's a lot of other things you can do. There's ways to protect and to defend your positions, to defend your portfolio, to insure it against loss. And that's really those are important skill sets to learn.
Yeah. Well, and frankly, guys, we do a free show here every day. If there's somebody in your life out there that you're thinking, man, they really need to learn at least about this or hear some real truth, click that share button and put it on your favorite social media feed and just say, hey, guys, just come and join these guys, because we've been on this for a long time, Mark, and we've been calling it like it is for a very long time. And this isn't an I told you so. I don't get any joy from the markets going down. I don't get any joy from it. I don't think anybody's cheering for that. But it's about responsibility. And if the market breaks down again, we have to be there. There's an old maxim on Wall Street: bulls make money, bears make money, hogs get slaughtered. And I think at this time, that is more true than I can remember in any other market condition. There are bullish thesis, Mark, that still will play out very well. Buying Zoom a month ago made a lot of money if you did that, right? Buying into companies at certain levels where you're willing to own it long term. I'm not saying there's not a case for the bull side of this argument at some point or in certain areas. In fact, Mark, you were even talking about yesterday some naked puts that you were looking at and all that kind of stuff. So I get it, but you also need to wrap your head around the bear thesis. Right now, we're sitting on intraday support. There's no question about it. Coronavirus data is going to be ugly every day. I know that. I don't think that's going to be the thing that tops the market, though, Mark. Don't you think this is maybe a technical issue here, that traders are going to wake up and just say that chart is ugly?
No, I'll answer that in a second, but I just want to say one thing for 15 seconds. Like, we've been talking about the coronavirus since mid-January and trying to give you honest analytic, like, no matter what the markets, if you want it, tell your friends and family, this is a free show. We're never going to sell anything on this show. This is an information show that we do for the better good, if nothing else. And then, of course, to highlight who we are. But if you want honest information about what is going on, not talking head nonsense, honest information about what is going on in the market and what is moving things and what is moving things. Like, I don't know if there has been any place in the world, and I say this with pride, and I say this, and I would put it up against anyone, that is giving you a more balanced, honest approach about what is happening in 2020 with financial markets than we have. We have been a dead on. We have been spot on. We're not always going to be right, but we're going to give you our honest opinion that is unbiased by politics, by outside interests. Alternative media is something that has been growing steam for 5 years and will continue to grow because you get it straight. There's no agenda. There's no agenda other than analysts. But from a technical sentiment standpoint, this is an important concept to realize for the moving forward. Fundamentals are irrelevant moving forward for months and months and months moving forward.
In the short term.
Yes.
I'm still open to the fact they might come back to relevancy at some point. I mean, in a more normal market, we'll start looking at PE ratios again, don't you think?
We'll look at PE ratios, we'll look at economic data, but right now it is, nobody knows. Like bulls, people that have a bullish thesis and even a semi-bullish thesis like I do, don't know. Bears will even say, you don't know, and that's why it could be bad. People don't know what the meaning, because we've never been through anything that even resembles this. We don't know what things will look like from an earnings front. People are guessing. People are guessing. And so right now, the market on a daily basis is almost purely a combination of sentiment and technical analysis. You saw this yesterday, right? Where technicals, you had a day on the intraday chart for the first time in a while where support and resistance bounced back for a while. You know, you're seeing this on some level on the daily chart for the first time. That's a good old-fashioned 5-day range, isn't it? With a clear resistance level coming up against a very important support level.
And support could, I mean, it wouldn't surprise me if the market bounces in a little range.
And Noah, show the Fibonacci's on the daily chart.
You know, all right, well, this is a really fun lesson. So first of all, I actually have these two lines drawn on there. Those are just price levels, but I derived those from Fibonacci ratios. And what I did is I measured the entire drop from tip down to trough. And then I measured just this middle wave where, we saw the rally here and then the secondary drop. Mm-hmm. So when I measure those with the little Fibonacci retracement tool, and again, you can start tip to trough, and there you see we're hitting that 38.2%, and then that next zone up there is the 50% retracement. And then when I took the second measurement, which is, again, what I'm looking for is what's called the Fibonacci confluence, I came up with basically the same ballpark answers. That the same, 38.2, they actually overlap. You can see where the Fibonacci's line up in the same zip code. And all that really means is that different traders, different algorithms using different measurements would come to the same type of conclusion, that those are probable catalyst zones, for selling, a potential resistance zone. Now, if you do draw enough lines on a chart, you'll hit something. That's something we always joke about, right? But the fact that they line up just like that, and then that 20-period moving average is coming down, and that's exactly where that double top formed. That tells me that, yes, I already knew this. A lot of the algorithms do run on Fibonacci's, and they use the mathematics behind the Fibonacci's and Elliott waves to help them, to execute those trades. And so, and then it becomes a bit of a self-fulfilling prophecy in that regard. And, if you go back and study previous market crashes, even amidst all the chaos, there still is an order and a pattern to it. Mm-hmm. And I think it's just deeply rooted in our human psychology, where, you could kind of weigh out all the psychology, like all the fear, the greed, all the hope and optimism, and all the, the fear and pessimism going into that. It just kind of plays out, and then people respond and react to each other. And then the algos are in there. And it's just interesting to me how good old classic technical analysis can really give us an edge.
Isn't it amazing? I mean, take the emotion out, focus on the chart, trade what you see, be data-driven. Don't ignore the problem. I love this. I mean, absolutely 100% love it, because that data is there.
Now, and if you don't understand Fibonacci's, and a lot of you won't, right? If you don't understand technical analysis, and a lot of you might be joining us for the first time or fairly new, what it basically is these predefined levels where computers, algos, what we call, come in, are executing a ton of trades. They're exiting bullish trades, they're entering bearish trades. And that is a beautiful order to the market. It allows us, in the midst of all of the chaos that is going on right now, where we don't know anything, right? Still to have things that can help guide us in our short-term decision-making in the markets. Because if computers are doing something in rapid order at something, if they have regained control of the market, this is really, 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 really beneficial for us at Tackle Trading as members of the community, because it can help make some short-term decisions have a lot more logical basis for them. So computers, algos, they get a bad rap out there by people. It's like, oh, algos. Yeah, think like an algo. What are they going to do? How are they acting? And this is a lot of like when we give our analysis, this kind of things are incorporated into it. So that was just a good old fashioned, came up to a level, and it wasn't going to go any higher unless you had a catalyst. It didn't happen. And the longer you stay at a resistance level, if you don't break, there's only one other direction, right? If you can't break resistance, it can only go in one other direction, right?
Yeah.
Same thing with support, right? If you come down and form that support level and it hangs out for a few days, if support doesn't break, like for example, this short-term support that's going on, if it doesn't break, it can only go back up again.
Yeah. This range is big. I mean, this range is so important. The next 3 trading days, in my estimation, might set up the entire month of, April. In my personal opinion, we'll wait and see if that actually plays itself out. But you've got this 2400, 2650 range that we're going to be watching like a hawk. Noah, give me usdebtclock.org for just 2 minutes here. We're not going to go off on a long rant, but I just want to look at the numbers real quick. I read an estimate, just to give some people some updates, from Citibank, an investing group over there, that said our federal deficit this year is going to be 3.7 trillion. Now, to give you some context, current federal deficit is 1.4 trillion, which has been the highest level in a long time. But 3.7 trillion, guys, relative to our GDP, is about 15 to 20% of GDP. which means that's the highest level since World War II. They estimate that that deficit is going to be there next year as well. Mark, the second theme that we just do not have clarity on is all this stimulus talk. And you actually had a really good point earlier before we went live. Maybe we shouldn't call it stimulus.
Yeah, I think.
I mean,
and
it's just to get people by, right? Go ahead.
Yeah, Tim and I talked for about an hour and a half before the show, and we were talking about different things. And, you know, because we're so used to the federal government spending money and us calling it stimulus, which in a normal time would be correct, right? And I've been guilty of this myself over the last month, where like, you know, like in a normal recession, all right, where, you know, where there's not this huge event like the coronavirus, but in a normal recession where things are maybe pointing to a recession and things are steady, maybe steadily declining, the government coming in and saying, we're going to do this. Well, it's truly putting money into an economy that is designed to stimulate, that is really stimulus money, because the economy's here at point A and the government comes in and puts in money that lifts the total potential productivity in the economy. And so we're so used in a classical sense to thinking of government money as stimulus. But that's not what's happening here, isn't it? Is it? You have literally areas of the economy that have zero productivity, airlines, for example, or close to zero productivity. And the government's coming in, sending all this money. You have individuals that are laid off. That's not stimulus money. They don't have more money than before. They don't have more productivity before. It's not stimulus money. It is get by money. It is try to hold the status quo money. It is try not to stop the bleeding money. And so this whole bullish argument about stimulus, using that term, I think is really, really misleading. And I apologize for not thinking about this before, because I've used it in that exact same way for weeks and weeks, because you're so used to thinking of government money as stimulus money. But this isn't designed to stimulate the economy. This is designed to replace missing productivity. And here is just money to try to hold the tide.
Life support.
Yeah, it's life support money. And so like one day, if the government came, let's say we hit a bottom in the economy and things started going up and things were moving, if the government then came in and put in $2 trillion, well, that would be stimulus money, because the economy's at a certain point and it's starting to climb up and the government puts in money. Well, that could help kickstart it. But that's not what's happening now. This is life support money for companies. This is replacement money for wages, and even probably not even at the levels that they previously were. So not only is it not stimulus, not only is it not just status quo, it is probably, as Noah said, more it is probably better used as life support money, which really takes some steam out of those ultra bullish arguments if you buy what I just said. Like, because it's not stimulating, it's life supporting. And is it even enough? Like, is it even enough?
Well, and that liability per citizen you just zoomed in on there, Noah, that's pretty concerning, obviously. We listen, the government's giving you a $1,200 check, but we owe probably about $410,000 per citizen. Now, we're going to have to put tax dollars to work at some point over the next decade and all that kind of stuff.
No, we're not.
We got to get off this page.
This page always stresses me out.
It's giving me a headache. I need to get off this page. More on
modern
that.
Monetary theory, they would say, right, that it doesn't matter how big those numbers are.
We live in the matrix. I get it. Markets are at the daily lows here as we're talking about the major headlines. We're going to get into companies here in just a minute.
Hey, will you go to an intraday chart? Because I want to see, because this keeps bouncing off this level.
Yep.
Like, what is like
the Sunday futures open last week was this exact level. So you have some support, just technically some horizontal support right in here.
But we like, so.
And if you go to the hourly chart,
like, I'm trying to see how strong and how many times this is.
You have the 200 hourly sitting right here as well, Mark.
Well, it's been resistance, support, moving average, the cash open. It's quite a few.
Are we on a double band right now?
Yep.
Are we on a 200 hourly and a horizontal resistance level?
Yep, we are.
Oh, this is a battle. Holy cow.
This is a key level.
This is like, a battle.
Mark, whoever wins this fight could dramatically impact the rest of this week, if not next week for traders.
Well, this week, you know, I don't want to get too far ahead, but this battle right now is the battle. Like this is like you have downward pressing moving averages everywhere. You're coming against a support level, forming a pinch. Like if you put on, I mean, I wish you had an email. Let's see. No, you got a good old fashioned pinch developing at a key level. And there's not a lot. That's a lot of clear air to the downside.
Hey, Mark, just for fun. It's a triple level.
Oh my gosh.
Oh, 38.2%. That's a big one.
This is a massive level. Like it is triple band support, horizontal Fibonacci, and a major significant, the 200 hourly is one of the most major. I'm gonna retake that. It is the dividing line on intraday charts. It is the most important moving average, in my opinion, there is. If you break through this level, there's a lot of downside. But once again, if you don't, boy, this is really big right now for price movement the rest of the week.
Yeah. If we get any action throughout the halftime show, obviously we'll come back to it. Let's go quickly through the commodities market. Crude oil, there's a lot more chatter. Trump and Putin, I guess, got on the phone overnight, but nothing really came out of it, Mark. They're going to be leasing space in the strategic oil reserve to crude oil companies if they want to, but quite frankly, none of it matters.
Cute.
That's cute in the short term. They don't have enough space, and the price pressure will remain at least in the near term. Mark, what's your read on crude oil today?
Well, I mean, here it is. You had the first big casualty in Whiting Petroleum today, who filed for Chapter 11 bankruptcy. Go to WLL. WLL. I mean, this is why for weeks now I am mega bull on acquiring oil at low prices from a long-term investing standpoint. I have naked puts, full disclosure, I have naked puts on USO. I intend to acquire more USO at lower prices. I adamantly am convinced of my long-term oil thesis, but on individual components in energy, I'm not as bullish. Chapter 11 bankruptcy today by Whiting Petroleum, who just a year ago was at $31 or so. Just a year ago, $31. There is risk of ruin at the highest level. Now, risk of ruin, and I use that term, means company can go out of business, can declare bankruptcy. Now, Whiting Petroleum in their Chapter 11 is going to reorganize creditors, going to get 97% of the shares, basically own the company. They're still going to stay operating. But the risk of ruin on individual company levels is the highest in oil than anywhere else. And, you know, first big casualty in the group in Whiting Petroleum. But, the oil is wow. It is.
Check that chart out, Noah. A year ago, Mark, that was at 30.
Yeah.
I mean, listen, you know, fundamental. In fact, it was a 56.
Year and a half ago, it was at 56.
56.
And they declared bankruptcy today.
Yeah.
It declared bankruptcy. The preferred play, in my opinion, is oil itself, USO, because I believe all of this has to play out one way. And eventually, because of storage issues, because of bankruptcy issues, you just can't, because of Putin, Trump could lay a $50 or a $20 or a $30 tariff on foreign oil. You could have an OPEC nation start a war with Saudi Arabia, and I'm talking a shooting war. You could have just companies go out of business. You could have the coronavirus. Eventually, you are going to see oil up in price at some point. In the short term, though, it's a mess. So it is definitely a long-term thesis with a lot of moving parts.
Well, the short term could be months, right, Mark? I mean,
no,
months.
You're not playing an intraday bounce in oil. You are buying oil, USO naked put style at lower levels, and you are just sitting there.
Well, you might be trading an intraday breakdown, though. If it breaks below 20, I think there's a trading signal potentially there. 20 has been a very, very key level of support. Take a look at this here, guys. I mean, we're dojing for a couple of days down here. And if you go down to like the hourly chart or whatnot, you're in a low base. It's hard for some traders to want to sell short after something's dropped like it has here, Mark. But you could even, I could logically understand an argument for bearish short-term trade right here.
Of course. No, most oil bulls like myself expect lower prices. The probability of lower prices is really, really high, right? It's just it's a complicated.
It's complicated. That's right.
It is.
It's like a Facebook relationship status. No, it's complicated. I like that.
I mean, I know that seems crazy to someone listening to me for the first time, because I go into this more on my weekend reports more in depth than I will this weekend as well. Because you're like, you expect it to go lower. Why are you bullish? It's a complicated relationship with oil right now. So I could go off on 45 minutes, but yeah, it's a mess. But those individual stock companies on oil, there's a lot of risk of ruin.
You're going to see more of that, like Whiting did. You'll see more companies really have to file or get emergency funding or whatever it is. The big ones, actually, and Mark, I even heard this, a lot of these big companies like Exxon and Chevron, they don't want the government to step in necessarily, because they might see this as a way to even consolidate more of their power over the oil industry. I don't think it hurts Exxon and Chevron to see these small shell companies going under, does it?
No, it does not long term.
It does not. Gold real quick here, Noah, hanging around that 1600 mark. There's not much there in the chart unless you're seeing something I'm not. Same chart.
Same chart. This is green candle.
Same chart.
A little upward confirmation. Looks pretty.
Yep. Dollar index, a break above 100, I actually think is pretty good confirmation here on the index, 99.68. That deep pullback has now started to solidify here a little bit. We did get some economic data I thought was really, really interesting overnight. But quite frankly, the funniest thing I heard you tell me today, Mark, was on CNBC how so many analysts were lauding the Chinese PMI data yesterday.
There was, accurate. I mean, like, if you watch CNBC, and there are a couple people on there I respect, but as a whole, it feels like a propaganda network. You had one analyst yesterday laud as an example, like why the coronavirus isn't going to impact and why you should be a bull, essentially saying, hey, look at China, their PMI, they're back up and running. Usually, literally using the Chinese data as an example of why you should be bullish on U.S. stocks. Because look at China, they cured it and they're up and running again. And I'm just like, anybody that watches CNBC for anything other than entertainment value only, I don't know how to help you. If you can't actually educate yourself and have to trust talking propaganda heads on CNBC, I don't know what to say, because once he said that, I was like, I looked at the TV and I'm like, are you stupid or are you trying to manipulate me? And I couldn't tell the difference. It was one of the two, though, right? If you believe that Chinese data, you are a complete idiot. You just are.
There's nothing that would make you believe what's coming out of there right now. And good question in the chat here from Johnny, gold versus the dollar. Historically, Johnny, the old analysis was always dollar up, gold down, dollar down, gold up. They were an inverted relationship, but they can decouple at times because they're both seen as safe haven assets. So there can be times, and Noah's bringing up a really good indicator here, a correlation indicator. There can be times where they both go up at the same time. So you can't just always say one up, the other one down, because they have some safe haven type things to them. What is that correlation effect?
So the correlation, so historically speaking, gold is negatively correlated. And so the way that this indicator works is I'm comparing the dollar, which is the chart we're looking at, to the actual gold contract. And 0 means no correlation. 1 means positive correlation. -1 means negative correlation. And if I hover my cursor on 0, you'll see the vast majority of the data occurs below that 0 line. So it is negatively correlated, but from time to time it breaks down. And when it goes to positive correlation, that means they're running in the same direction. When it's running negative correlation, that means that they run in opposite directions. Again, you can see that most of the data is down below. And it oftentimes is hanging out down here near -1, where we do expect it to be negatively correlated.
Keep your mouse on that 0 line real quick.
Yeah.
So like in 19, if I'm looking at that right, there were 2 periods where it became positively correlated, but for most of the year, it was negatively correlated.
Correct.
But here in 20, we've actually already had 4 periods that were positively correlated because probably all this rush to safe havens, I'm guessing.
Right.
Yeah.
Yeah. So, I mean, the correlations do break down. So you can't really say gospel truth. Now, it's really hard at some point in time to break those two apart, because obviously we value gold in dollars. We value stocks in dollars. We value everything in dollars. And so when we look at people, using gold as a value store, and gold as something that's fungible where you can transact it, there is a correlation, and they can't stay positively correlated for too long, and they can't when they run opposite directions for too long. They also really have a strong tendency to revert back to the mean. So if the dollar runs up and the gold runs down, or vice versa, and you get overbought and oversold, you'll see them revert back to the middle. And so you'll notice that every time it gets down really strongly negatively correlated, it kind of snaps back to zero. And so there's a lot of ways that traders trade, gold, and they trade the dollars. They watch for those extreme levels. They'll watch for the negative correlation, and when gold's up and the dollar's way down, and then they snap back because, hey, if gold's up and the dollar's down, there's a transaction to be made.
Yeah. I love it.
No, I had traders, because we've been bullish across the board on gold for 14 months, 15, 16 months now.
Mm-hmm.
And at the start, individuals were saying, well, I'm going to wait for the dollar to come down. I was like, you can do whatever you want.
Yeah.
like you can play your classic correlation, all of that. Screw that. The fundamentals are way too powerful on gold right now. They trump the dollar. And that's been my stand. I mean, I was like, I didn't openly mock. I probably did, because I sometimes lacked a soft touch, but I was very strong. No, listen, those old ways of thinking, it's not a binary thing.
Mark acts tough, Noah, but just the other day he brought me a little package of toilet paper, saying he was thinking of me. So he's a softie. I think this tough, gruff attitude, Mark, I think it's just a show. You're a teddy bear, aren't you?
Well, I mean, was it like really ultra plus Charmin type toilet paper,
No,
or was it like
was.
single ply sandpaper kind of toilet paper?
Dude, listen, that's hidden in my personal storage supply. My daughters don't have access to it. So Mark's gift, I'm hoarding for myself, from my family. But no, we're good on that. No, I'm with you, Mark. I mean, here's the thing, though. Buying gold, waiting for the dollar to come down, it lacks one basic understanding. We live in an international currency system. Quite frankly, waiting for the dollar to come down, what are you waiting for? The euro to go up? The yen? Which currency do you think is going to be bullish to make the net effect of the dollar come down?
And that's the thing. And it's a more nuanced argument. But you got to realize, from a fundamental standpoint, the currency as a whole is one of the reasons of the correlation with the dollar, with gold. But it's not just the U.S. dollar. Other currencies as well play a role in gold pricing. And so that relative mess of all currencies being fiat currencies, and I want to go on a one day we're going to have a reset argument right now.
Mm-hmm.
But there's lots of reasons to say that gold, especially selling naked puts, entering at lower levels, boy, I just remain a fan.
Currency reset would lead to an argument as why you should own Bitcoin. We're not going to go there, though. I don't want to pick a fight right now.
No, because when they reset, they're going to make a national Bitcoin. So it's not going to be Bitcoin even in that scenario.
Yeah. Bitcoin looking pretty ugly as a bear retracement. By the way, you could use that tonight as an example, Noah. Broke below support, bear retracement, bear flag, a little breakdown below 6K there. It's ugly. That's an ugly chart on Bitcoin. I don't care if you're a true believer or not, right? That's an ugly chart.
Even the Bitcoin believers have doubts right now, Tim.
There's no doubt. Let's talk individual companies here, guys. Broad markets, we've kind of hit all the themes I want to talk about today. We can get final thoughts later. Let's start with Carnival Cruise Lines. The bailout on these distressed industries. Well, we learned last week it wasn't going to happen for CCL because they're not incorporated in the U.S. Mark, they are looking for $6 billion in private funding from Wall Street. Some of that money, they're actually going to resell some stock down here at $10 a share. So buy back your stock when it's at an all-time high and sell it when it's at the all-time low. What are these companies doing in the last 15 years? Doesn't make sense to me, but they have to. They need the money. And the other thing is they're looking for about $3 billion in notes, bonds, they're going to pay 12.5% guaranteed on, Mark. Now, do we believe Carnival has enough potential in the future? This is one of the biggest cruise lines ever, that they could actually fulfill that debt obligation. Do you think Wall Street's even going to buy that?
Do bonds come with a free cruise?
Dude, they might come with a free cruise line at some point and when they go bankrupt, but
it's hard because, oh my goodness. Hey, you know, someone bought Carnival last week being like, hey, it's cheap. Let's buy it at $15, $16, $17.
yeah.
Hopefully it wasn't anyone at Tackle Trading.
Yeah. It's amazing to me what these companies are going to have to go through. Distressed industries, by the way, today there's a theme here. Macy's, the retail space, they got bumped out of the S&P 500 today. They furloughed so many employees. I've been talking about how this is a garbage company for years, by the way. I think we all have. How many times out there, Breakout Frank, how many times was this on our stock or options report as a bear play one way or the other in the last 2 years? We had it forever, right? And here we are down here at $4.50, and they're now off of the S&P. They had to furlough almost all of their employees. They have no idea when they're going to open back up, Mark. Just an ugly one. So there are some examples where, yeah, it might be at a low price, but I don't know if that's cheap yet, Mark, because there's still, that company may go out of business at some point.
Like when you're bargain shopping, like let's say you have a bullish thesis, it is really, really important to believe in a rebound in the company itself. Mm-hmm. Now, if I buy 100 shares of Cinemark Theaters or AMC Theaters at very low prices and maybe have a speculative position, I'm risking risk of ruin, right? If the coronavirus is nasty and this thing goes on, some companies might go under, which is why you only allocate a certain percentage and you're being very careful on any given position. But on industries that were facing really terrible trends anyways, clothing stores, retail fronts, these trends were terrible before coronavirus. You had shifting demographics before coronavirus. Like the ability of Macy's to withstand shifting consumer behavior. Well, consumer behavior was already shifting. This is like gasoline on the fire. It makes my desire to get into a Macy's at rock bottom at $1, right?
I mean, even before all of this, I always thought Macy's was one of those top on the retail apocalypse list. Their demographic is aging. Young people don't shop at stores like Macy's.
Are you calling my mom old now? No, is that
your mom and my mom both?
Yeah. My mom loves Macy's.
Yeah, my mom loves Macy's too. And so people who really grew up with that being like the brand awareness. I mean, Macy's, it was, absolutely, one of the best, retail outlets out there. But it's, the local Macy's, every time I've gone to one, and I only tell I poke my head in one around Christmas time every year, and it's always, even still, there's not a lot of foot traffic. And it's just those old department stores. It's just not the business model I think people are into these days. So, this is kind of a foregone conclusion. And to see him finally removed from the S&P, it's like, what took him so long?
Yeah, I'm with you. Ugly chart. There's no question about it. They do have over $1 billion in cash. They're only a $1.6 billion company. Do you ever get to a point, Mark, where you start looking at the numbers and your brain starts to convince you that maybe there's an idea there?
No, I use like in all of this right now, and we go over this in great length on our weekend shows for pro members. You have to suspend those type of fundamental things. And do I believe this company will survive? And it is a qualitative argument because we don't have quantitative data. They might have $1 billion. How quickly are they going to burn through that? How quickly are they going to continue to burn through it even after stores open again? It becomes really, 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 really difficult if you don't believe in the company. And it's not just a management issue. Do you believe this type of company will survive?
Sure.
And it's a really hard argument on clothing and apparel stores in certain retail categories. Will they survive? Now, will Home Depot survive? Yes, Home Depot is going to survive. It becomes a question of price then, right? At what level do I like Home Depot? Because I believe that will survive. But once again, people were buying Home Depot at $195 last week, or last week, 2 days ago, because hey, Home Depot's cheap. this has been my base argument about companies that will survive. There's no question Home Depot will survive, right? Huge brand name, huge access to capital, like it will survive. It becomes a question of price then. At what level am I comfortable buying Home Depot? And like buying Home Depot 2 days ago, which some people did because, hey, it's rallying, I can't miss out. Well, that's assuming you're taking, I mean, my goodness, it just seems like a greedy bet. It seems like a stupid bet to me. Home Depot becomes very attractive at lower and lower and lower price levels. But can you
look at that sell the rip though? I mean, that's fine at lower levels. People are getting way too ahead of themselves last week though. I mean, you were talking about literally backfilling into old moving averages, coming from 140 to 200, a key level, pivoting. And I kept hearing, even yesterday, Mark, on CNBC, buy everything. It was almost like, and I mean, I don't ever turn that channel on for a reason, but I'm just looking at this and I'm thinking there's not a technician in the market that would look at these patterns and find a buy point. Not yet.
No, they're literally buying on hope. They're literally just price is cheaper, right? Hey, it was at 247 at a high. It's only at 190 now. That's cheaper. But that doesn't make it a better value. That doesn't mean it's less expensive. It's just, once again, y'all can do whatever you want to do. I'm going to be very, very, very greedy. And this is from someone that's a bull long term. Would be very, very, very greedy and very, very selective. I've said this, and you've heard me say this for weeks and a long time. If this market just V-shapes and goes back up to highs, I'm going to miss out. And I'm going to be happy with that decision. Happy is not the right word, content with that decision, because based on what we know now, that seems like, hey, anything can happen, right? But that seemed like something that I wasn't like, I'm not going to worry about it. I'm going to wait for more data, wait for better bargains, be very, very selective. And getting back to Macy's and retailers, and you had Nordstrom on there for a second, man, it's just like after oil and gas companies, boy, most retail stores fit that. Yeah, I just don't know. Cruise lines are there too, right? Like, are cruise lines ever going to be the same for years after this? Maybe, right? Like, maybe, but like, and there might be a point where I'm willing to speculate a little bit, but I just don't think people are going to be paying full prices for cruise in the next year or two on any level.
Which brings me to the big one, in my opinion, Apple Computer. Bringing up Apple, you know, Bank of America and Merrill Lynch, they actually added the stock to their best investment ideas list. And Argus, who rates the company, actually reiterated their buy rating, even though that is one of the ugliest charts in the whole market. And what is it about Wall Street with this company where they just will be holdouts no matter what and have a positive view of this company no matter what happens in the economy?
Well, naturally, Tim, if you want to sell a product, you need to get somebody interested in buying it, Tim. So what you got to do.
That was stellar, Noah.
100%. Oh, so
well, no, I mean, Apple, it'll be a great buy. I guarantee you it's a great buy at a certain point in time. But that chart to me currently suggests more bearishness. And hey, if you like it at 242, you're going to love it at 200. You know, that's kind of my take, is that patience is a virtue. And, you know, if you are the cost average person and you want to buy a little and, you know, nibble, that's fine. But you can't, you know, you got to keep your powder dry, because if you really want your cost averaging to work, you want to lower that cost basis. That means you also need to pick up more at lower prices. So, you know, be patient and wait for signals, wait for turnaround, wait for us to at least get out of quarantine and see what happens with the jobs market. Because again, people who are unemployed don't necessarily buy new iPhones.
Yeah. And by the way, I already know this is one of the most held companies out there in the market. We probably have a lot of people who are watching us right now who love Apple and are going to hold Apple and have done well with Apple. I would never criticize somebody's long-term investing in a company when it's been years and years and decades. But I see through the Wall Street BS as well. Noah, what a wonderful way to say that's going to make me laugh all day long. I mean, here's the thing. In the short term, there's so many unknowns about economic activity and what's going to happen. Who's buying iPhones? I mean, yeah, later, sure. Everybody gets back to work and the economy comes back. Yeah, sure. But this one is a huge risk, in my opinion. We talked about it yesterday as well. But
I mean, companies that aren't even at 12-month lows or even close to them, that aren't positioned to excel, like in this environment, like Zoom, positioned to excel, Teladoc, positioned to excel, like certain industries are positioned to excel, or at a minimum, maybe you could say a Kroger, positioned to maintain. Apple doesn't even come close. Apple's not in a position to excel in a recessionary, brutal environment with a high price product. That seems insane to me.
Look at what happened in 2008. Real quick, Noah. Just look at Apple in 2008. This idea that the market darlings cannot go down, and you might even need to kick that back. Oh, it's funny how it's been that long, huh? I mean, Apple did drop. Oh, where are we at? Right there. Now this is pre-split, by the way. They split from there, but it went from around, what is that, $30?
Well, they did a 7-for-1 split and a 2-for-1 split, and so they've had a couple of splits. But yeah, back in 08, it went from, at the time it was around 30 down to 10. Now those weren't the actual prices, because again, they've done a 7-for-1 split in between there. But again, that is a 60% drop in price from highs of 30 down to lows of 11.
Yeah, and just in the United States, if you say, well, United States, Apple sells a lot of phones around the world. Are they going to be, I mean, to me, it is insane that individuals would say a company that has a higher price product, which in normal conditions, people are happy to pay. We've seen this for 10 years, right? People love their iPhone, they're integrated. But it's that upgrade, right? It's not people that love, are part of the Apple community are going to switch. That's not a question. They're going to keep existing service, but it's like those upgrades.
So would you say this is a fair assessment, Mark, on this weekly 200-week moving average? It's a buy. It gets down to the 200-week moving average. It's a buy.
To grow. There's lots of things to love about Apple. It's not.
We lost our connection, guys. So.
Oh no! Here we go.
Is it back? Does it feel like it's back?
I have no idea.
We're back. We're back from outer space. We're back.
Did we get it back? Tan Man, did you just come in and save the day?
I don't think it was me.
Well, you should have taken credit, young man. I mean, you're the one. Listen, it'll be like, yes, Uncle Tim, I definitely nailed it. By the way, Matt's son is doing our hosting here today. Everybody say hello to Tanyan out there. And he came in. He's been learning Zoom while Cody had some positive news here today saying the baby's doing better, Mark, and things are turning in the right direction. And
I love that.
I talked to him, and him and his sweet wife just had their first child. So Cody, everybody, thoughts with Cody out there in Hawaii. Pretty cool what's going on in our lives, no doubt about it. Let's move on from Apple. Let's talk real quick about some companies while we have a connection. By the way, if we lose a connection today, we're not coming back. Today, we would end it, and we would call it after that. But let's go through quick rapid fire on some stuff. Let's start with some of the cell phone companies, Verizon and AT&T. They're meeting with President Trump here today, guys, on the phone, not an in-person meeting. Talk about bandwidth issues. I'm very curious to see what they have to say. I want a surety that they have the systems in place to handle the upswing in usage and all that kind of stuff. Mark, that could be a problem if the grid has problems, don't you think?
Yeah, I mean, I've shared this a couple times. Verizon's one of my preferred plays at lower levels for naked puts if you want a stability company. Mm-hmm. But yeah, I mean, obviously, if we have internet issues, who knows where the hell the bottom of this market is. Sure. I'm going to be optimistic because we need internet's what's keeping us all sane, right?
Yeah, 100%. We need definitely connection, even just to trade and all that kind of stuff. I don't think there's going to be a problem, but he is meeting to reassure people and have that conversation. Give me a look at Cronos, CRON. There was some chatter about New York State passing a legal pot situation, but the governor basically came out and said, listen, guys, we're nowhere near that. We're dealing with coronavirus, so they had to delay it and punt. The medical marijuana industry has been looking for any good news for about a year and a half. Haven't got it here today. Marriott, MAR, if you can, real quick. Talk about more bad news when it happens again. And Noah, you got Marriott?
Nope. What's that? We're looking at Marriott.
Marriott next. Yep.
Marriott.
They had a data breach in Russia, Mark, and 5.2 million customers' data was stolen. So they were already under pressure. They have all these problems. And then here we go. The hackers are coming after their user databases. Not good. Distressed industries. I mean, you look at that. That's an ugly chart.
Hey, listen, we live in interesting times. If you were bored a few weeks ago, you aren't bored anymore. I mean, these are interesting time. Reports are coming out today along with new things. China's locking down again. We're starting to get reports that they're actually admitting after U.S. intelligence is accusing China of outright lying about their situation. We're getting reports from Reuters and Bloomberg that different sections of the entire country are locking down again, instituting more measures.
Yep.
Yeah. It's a mess.
It's a mess. It's a complete mess. Anybody who believes what's happening in China right now, there's, just too much evidence that they literally have been disinforming people.
But somebody on CNBC yesterday were saying, hey, look at the PMI numbers.
Why anybody would watch that channel, I have no idea. Boeing, real quick, take a look inside the Dow. And guys, we talked about Boeing and all of that snapback rally. Talking about a bear retracement, bear flag, sell the rip situation there last week, guys. Noah, this is the kind of pattern you're going to be teaching tonight in our webinar, correct?
Absolutely. There's going to be, really two topics tonight. We're going to talk about the bear retracement pattern. And again, we're going to contrast that against the investment thesis, where you're looking to buy stuff. But there's tons of trading opportunity right now, Tim. And I think the bears, setups out there, there's so many good quality setups where you can do controlled risk entry. You can take, reasonable, rational positions with stop losses, and or with options using, some sort of options to hedge or protect it. So you've got limited downside risk on the portfolio, but you can take advantage of those drops. And the volatility on the downside, I think, is there's money to be made in bear markets. That's for sure.
Yep. And look at American Express. I mean, Mark, we had that conversation about the credit card companies yesterday. Here's an area of the market, AXP.
Oops.
I know you're thinking Amex.
But I know the symbol. It's just one of those brain farts. You go.
Mark, credit card companies, these were some market darlings for 12 years. And it's hard to really see a bullish argument for these companies in the short term. And I know they don't necessarily go into the Wall Street lending and the leverage and all that other stuff, but just raw consumer behavior. You're seeing a bear pivot there, down about 8% here today. Credit cards, Mark, these have been investor holders forever. What's your read on this industry right now?
I am a huge fan of credit cards as a whole rule. I love their business models. I love Visa. Oh my goodness, Visa is one of my favorite places in the whole world. They're going to get hit, as far as short term. And credit cards become a lot more interesting to me the lower they go. So these type of sell-offs, finding some kind of cost averaging in, and even if it is, remember, you don't have to buy things in 100 share blocks, right? For individuals with portfolios, starting taking nabs, even with 5-10 shares here or there on a Visa at certain points. The lower they go, and once again, certainly not today, right? Certainly not today. But credit cards as a whole are, especially companies like Visa that do not have credit card default risk, because consumers in worst case scenario are massively defaulting on their payments, right? You don't want to be in that area of the market. But a company like Visa, if you don't like Visa at certain price levels, you are a super bear, because you're saying this is all going to get really bad and it's all going to be end in gloom and destruction. That's not the camp I fall in. I see a light at the end of the tunnel at some point. Short-term pain, ugly. I think the market's irrationally stupid in some areas because uber bulls that buy every dip dominate price action. But the lower thing, it's funny, you're going to hear a correlation in my voice, Tim. When markets are rallying, I'm going to be people are insane, people are stupid. When prices drop and drop and drop, you're going to hear me lots more optimistic.
Sure.
Because, it feeds in my thesis. Because I want to acquire Visa at lower prices. I want to acquire things. And once again, it doesn't have to be 100 shares. It can be a few shares. can be a few shares, and it isn't today, right? Is it today? You need to have some kind of technical stability, most likely. But companies like Visa, if you don't believe in Visa, you believe that, well, it's all going to be crap. It's all going to be crap one day.
Mm-hmm.
So.
Yeah, no, I'm with you. So many opportunities out there in the marketplaces here, guys. I'm even seeing some really good bullish breakout setups. Look at Regeneron real quick here. Breakout of 500 is, I mean, there's not a lot of clean patterns in the market. I know there's some tails up there, but you're talking triple top up there, pressing up against some resistance. Take a look at T-Mobile, a little inverted head and shoulders pattern. You know, on that coronavirus watch list, Noah, there's still stocks that you could get interested in, right?
Oh yeah, absolutely. There's a lot of really good candidates in there. We're going to be talking about that as well tonight. So that's going to be kind of the theme of our little webinar tonight. We're going to be talking about that investment thesis versus the bear retracement, and kind of compare and contrast the two lists, and just point out all the awesome opportunities that we've been curating for folks. Yeah.
And real quick, if you are watching our show right now, as always, great to have you guys. # Team Tackle. Somebody in the chat just put in live tonight, 7 p.m. Eastern. We're going to be going live right on YouTube. We're not doing any kind of, crazy, special kind of thing where we have to launch some other show. We know we've got our YouTube audience here built in. You guys are awesome. And Noah's going to be teaching a bearish retracement. And that's a part of, it's a webinar tonight, Mark. And Noah's going to be teaching the technique, giving some examples, some mindset. And this is a part of our step system course, Noah. And it's also a part of a new series that we're going to be launching here on our YouTube channel in addition. Now it's live, not 4:30, Ben. It's live at 7 Eastern, which is 4 Pacific. Okay. 7 Eastern, 4 Pacific. Everybody write that down. 7 Eastern, 4 Pacific. Make sure you keep aware of the bell and, get that information out there on social media. This is the time. Just take a look at some of the sell the rip watch list candidates from over the weekend, Mark. We've had this list developing for a month. Look at Avgo here, Noah. Look at the backfill on Broadcom.
Those are pretty. That is pretty. That is pretty.
Pretty. Look at Chipotle.
Did it break that 666 level? It did.
It sure did.
That's a good looking chart too.
Yeah, I'm sure you're going to have some great candidates that you're going to be showing people tonight. What are you going to be doing? I mean, I know I pitched the big picture level. I mean,
big picture, we're just doing a live webinar. It's going to be ideal for folks who are new to tackle or new to trading, because I'm going to try to keep it on a pretty basic level for newbies. But we'll talk about some of the ideas and concepts out there, and we're going to be just promoting tackle trading. We're going to be talking about some of our products and services, but most of we're just going to be teaching. We're going to be talking about how to think about these markets, again, both from the investor standpoint and from the trader standpoint. And there are very different temperaments involved. But, whether you're interested in buying the long-term investment or you're interested in making money in the market volatility, we're going to be talking about those processes and just different ways to think about it. And this would be ideal to invite folks to, if you've got friends and family and people in your circles that could benefit from this information. It's because one of those things where, my ability to explain stuff to people versus somebody who's newer to this trying to explain it to people. It's just an awesome opportunity for people to get to know us and see what it is that we do.
Yeah, I'm excited for it. There's no question about it. And Mark, actually, one of the reasons why we're going live here at 7 is because at 8:30 Eastern, 6:30 Mountain, you're actually going to be hosting the Tackle 25 Mastermind group and talking a little bit about acquiring some distressed shares and covered call theory in general.
Yeah,
we're going to cover call traders.
We're going to talk. We're going to talk about I'm going to go in more depth why fundamentals don't matter right now, and how while they can be a guide in selection of candidates pre-coronavirus, it's really hard and you have to take a different mindset approach. And then we're going to answer any questions for pro members that have questions about their covered calls, their holdings that they're doing covered calls, and have an open discussion there. So we're going to do that on Tackle 25 tonight. Specific focus on covered calls, holdings, maybe entering in through naked puts of some companies, and how to manage all that.
Yeah. Guys, as always, if you're out there watching our show, and if you've not done it yet, give me the thumbs up. I like getting those analytics out there. Maybe YouTube didn't like us talking about Apple Computer a little while ago there. I know they're hand in hand. That's when we lost our YouTube feed for a second, but we got it right back up. And if you can, or if you want to, share this. Let somebody in your life know that we're going to have a webinar tonight. Say, hey, listen, this is a time for you to learn about how bearish patterns, bearish price action, bearish candlesticks work. And what better than just coming and join us here on YouTube for 45 minutes or an hour. So we're looking forward to all of these things. If you've been watching the show but never tried our pro membership out, there's always a link in the comments below. And I think today, we had the gaffe yesterday. We're going to make sure we do take it out when I say we are out, and that's now.
Wait, no, I got to share something first.
All right, go ahead.
Stop sharing your screen. I got to share something first. All right, so this is my final thought for the day. I love political cartoonists. I always have my whole life, and I think this sums up China very, very well right now.
Oh.
So yeah, no, nothing to see here. Nothing to see here. Yeah.
Carry on, right?
So
carry on. All right. Well, we are going to carry on. We'll see you guys back here. Actually tonight for the webinar, and then back tomorrow for the halftime show. We'll see you then, guys.